Good morning, everybody. Welcome. Thank you for all the early adopters that are here with us today in the West Crypt. My name is Gila Norich. I work at the Collaborative for Frontier Finance, which is a peer network for African GPs, and we do host a lot of events and interactions and engagements between GPs and LPs. And I'm also managing partner at Lida VC, which is an early stage tech VC. It's a strategic collaboration between Ida Capital and LVCN, and happy to share more about that in the networking. But welcome to the session on managing the LP-GP relationship. Let me just set the stage. So for the last decade, we've seen an increase in the number of GPs coming into the market, much faster than the growth of the number of LPs. Especially leading up to 2022, there was an increase in new managers, specialist funds, emerging managers, and then the market shifted. Fundraising got tougher, exits slowed, LPs became much more selective, which makes the LP-GP relationship even more important. At the end of the day, this is a long-term partnership, usually a 10-year relationship, often longer. LPs commit capital up front. GPs spend years building portfolios and supporting companies, and often are already out raising their next fund before they're able to return capital to the LPs. And that dynamic, of course, is even more real in emerging markets where the runway is longer, where companies take longer to mature and pay back. And so a big part of today's discussion is really about how both sides are managing that journey together, how trust gets built, what good communication looks like in this day and age, and really what LPs and GPs increasingly need from each other in today's market. So maybe before we kick off with some of our questions, let me turn over to the panel. And Andrew, maybe I'll start with you. If each of you can give a brief introduction about yourselves and the work that you do, and how kind of how your contributions would be relevant to this very important topic of LP-GP relationship. Andrew, over to you for introductions.
Great, thank you. Good to see everyone. So Andrew Scott, founder turned investor. Been investing for about 13 years now, done 150 investments over that time, mostly in deep tech and transformative sort of moonshot type companies, and currently raising our fund 3, based in the UK. But we invest in UK, Europe, and the US.
Hi everyone, I'm Shwetank, just flew in from Singapore, so forgive me if I slur my words, I'm trying to coffee up. I run Leo Capital. I started Leo Capital about 8 years ago. We manage 4 funds now, headquartered in Singapore with a global mandate. We have a very global base of LPs, from sovereign wealth funds to fund of funds to HNIs and family offices, so happy to cover that. And great to be here.
Hi. Hi everyone, I'm Huseyn, coming from a small but beautiful country, Azerbaijan, representing PASHA Holding, which is the largest asset manager in our region. We sort of wear 2 hats. We are LPs in some of the regional VC funds, but also we are managing, as general partners, our own VC fund that has been up and running since early 2026. Thanks.
Hi everyone. I'm Camille Tassi. I'm an investment director at Cambridge Associates, an investment advisor to large institutional clients. I work with European family offices and I help build their private investment programs. So that's across buyouts, growth equity, and venture capital. Happy to be here.
Great, wonderful. Thank you so much all for being with us today, and thank you guys again. So my first question really is about unpacking some of those changes that I spoke about at the very beginning. The LP-GP relationship is different. the LPs, they might know a fund, but for the fund two, they're reassessing that relationship. They're reassessing manager strategy. They're reassessing communications. Whether the GP that they backed maybe 4 or 5 years ago is really the same. So kind of today, what does a strong LP-GP relationship need today to be successful, to be thriving, that maybe was not the case, maybe 5, 6, 10 years ago? Wondering if anybody from the panel, just open it up broadly.
Do you want me? Okay, jump in. I guess the biggest change is that the price of money has increased dramatically, which means that people have become a lot more discerning about how much they want to allocate to venture. And that's sort of the biggest change over the last 5 years. So venture has become, everyone was opening and raising funds and going over their hard caps and all of that. That has changed massively because your hurdle rate has gone up dramatically. I think that is the fundamental underlying change that drives all the behavior. But the best practices that the GP, really, it's about, at its core, it's about building trust and telling LPs what you're going to do and then doing what you said you're going to do. So I think LPs really get worked up in this style drift or strategy drift. And if you're having that, you need to message that very carefully. But if you can build the trust and you can build the belief that there is repeatability and there is sense in your strategy, I think the LPs still continue to re-up. Obviously, performance matters, but it is not the be-all and end-all.
And so you're saying that GPs need to be much more disciplined now than they were potentially 5, 10 years ago?
Absolutely, yeah. I think things like portfolio construction, entry prices, all of that now matters a lot more in the diligence than it did 5 years ago, where you could have opportunistic bets. You could say, hey, I did this CDC company just because I love the founder. These things now get massively marked down than they were in 2020.
Thanks. Andrew.
I just counterpoint to that. I think it depends what sector you're in. I don't think I see a lot of discipline in the AI venture sector with a lot of GPs. I see a lot of lack of discipline, and I think we saw that also in the sort of the bubble a few years ago, where we stuck to our deployment strategy, which I think gained us, to your point about sort of doing what you say you will do, gained us some respect from our LPs. But a lot of people, arguably smarter than us, spent the money and then just raised a new fund within the bubble. We're a very small team, so that was quite hard to do. And so we ended up I had to accept, do I do a great job on deploying the capital, and then know that the bubble's going to burst and have to raise a new fund, or do I try and do both and maybe not do a good job deploying the capital well? So I opted to, I'm going to spend the capital really well, focus on that, and then now I've gone through the winter and we're heading towards our first close now, but it's taken a lot longer than it should because we didn't hit the timing in the market right.
So you're saying showing performance for you has been something super important. That's been a goal of yours.
Well, yeah, we just with 3 people, so I didn't have the opportunity to be in market raising and properly deploy the capital and look after your portfolio is incredibly hard.
Yeah,
and so I just made a decision that I'm here for the long game, and I'll suck up the cyclic nature of the capital deployment.
But I think where there's been indiscipline, there's been lack of re-ups after the bubble has burst. So it catches up with you. So the discipline, ultimately, if you're building a long-lasting firm, discipline of deployment and sticking to your strategies, I think, non-negotiable if you want re-ups from Fund 4, Fund 5, Fund 6. Because most LPs, especially the large institutional LPs, may underwrite like 2 funds, but to get you to re-up to Fund 3, they will look at that very carefully. And if there's been lack of discipline, it's very hard to get them across the line.
Yeah.
I was going to say that I think one of the big differences is LPs have become a lot more active in terms of their underwriting of re-ups. It used to be, okay, the manager's back in the market, we know them well, you look at the existing track record and a quick decision to re-up. Now you go into a lot more detail. You're challenging GPs, you might expect to have ask for co-invest, you go in a bit more detail into the portfolio companies. And there's a bigger focus on liquidity. When you're looking at, as an LP, you've got options, right? You can invest in buyout managers, you can invest in secondaries, you can invest in private debt. So you need to have a compelling reason to invest in VC. And if you're not getting the right IRRs versus some of the other asset classes, you might pause on recommitting. And we've also got, as an LP, you've certainly got more choice. And I think we are, if the decision to re-up or not is a quicker decision, and as opposed to, I guess, pre-2022. So LPs are more comfortable making that decision of not re-upping.
Got it.
Yeah, I agree with my fellow panelists. The financials are very important, but on top of it, what I'm going to add may sound a bit controversial. I think that what has changed, it has been there, but start to become more vividly clear is trust. Because once the exit environment froze, some paper returns stopped being credible. The bar for the trust has gone up, and the tolerance among the LPs, in my observation, has gone down. And at the end of the day, I believe that the returns are the outcome, not the reason LPs chooses you. So trust is a major component, whether it's a first-time investment or a re-up.
Got it. Thank you. Let's kind of follow this this line of thinking. And Shwetank, I want to ask you, your LP base is comprised of LPs from different countries, from family offices, institutional investors. How are you able to manage their expectations? Do you see that they have different expectations? Do they have different requirements in terms of what information you're sharing with them when you're visiting with them, what they want to see? How are you balancing that?
Yeah, it's a good question. I think a lot of LPs look at venture with different lenses, but it's really important that you make sure they're looking at the same truth. So the underlying thing that you're saying needs to be the same. But as a GP, it's on you to understand the different motivations of your LP base. So for instance, our LP base comprises from sovereign wealth funds through to individuals, right? Exited founders, etc. Liquidity needs vary, IRR expectations vary, need for recycling capital varies. So our approach is make sure that everyone understands the venture asset class, which is that it takes time, compounding is important, and that if you sell early or if you exit early, you will actually truncate your returns. But at the same time, be open to the idea that people want to be able to see money back, flow back. So build up. We built a secondary program where we enable people to buy out at NAV, etc. Small positions. Mm-hmm. Again, so catering for the smaller LPs while allowing the larger LPs to hold on and benefit from the long-term performance.
Interesting. And I wonder if you can speak more specifically, to the family offices, to institutional investors, to different types of LPs, kind of not to generalize, but to give a sense maybe for the audience, what is important, to each of those investor groups specifically?
Yeah, sure. So I think the large institutions, they want consistency. Really not slurring my words.
You're doing great. Keep going.
Consistency, repeatability, and succession. They want to make sure that this fund is going to be around in 10 years, in 20 years, because their cost of underwriting a new GP is large. So that's what the largest LPs are looking for, the institutional LPs are looking for. The family offices are much more sort of, it's an opportunistic question. I mean, most of them are looking for, can this juice their IRRs overall in their portfolio? And some of them, of course, looking for like totally game-changing returns. So they put in $1 million and they get sort of 10 out. And it's your job to sort of help understand. The institutionals are harder to convince upfront, but once you get them on board, it's a lot easier to manage that relationship. Mm. The family offices, individuals, it's a more mixed bag, and re-ups from them is a much more of a out of your control scenario, because family offices have hundreds of other things going on. So re-up is not based just on your performance and what you've done, but 100 other variables that are out of your control. So again, if you're building a fund, you need to think about how 50% of your ideal scenario is 50% of your LP base is solid, large institutions who understand how to run venture programs. This is I'm talking about Fund 1, and then 50% is other kind of money, and then you build it up to about 80% institutional if you can. If you get there, then you have a generational firm. If you don't, you have a crapshoot every time you're trying to fundraise.
And it sounds like paying some in-person visits is meaningful too. I mean, you just came this morning, right, from Singapore, and you have some meetings lined up for the week ahead. So you're really, cultivating and caring for these relationships.
I think LP relationships don't work on Zoom, so you do need to be in person. We can talk more about how to deliver good news, bad news, all of that. But meeting regularly and just being in person is I think, absolutely essential.
Thank you.
Somebody else.
Andrew, yeah.
I mean, I agree with all that. I just add to that, I think it's a bit like with a founder and a startup. You've always got to think about what's the motivation of your stakeholder. When you've got someone on the board, and it's the same on your LPAC or indeed your major investors as a VC. An institutional investor will behave differently because that's a career person who is covering their ass within an organization and is going to be conscious of the risk profile, therefore, because they're thinking about their bonus, they're thinking about their next move in their career, versus an individual, single family office, perhaps the man who made the money, who's got discretionary capital, who can do whatever he wants, as you say. So I think you've always got to, look at the human factor of what is this person motivated by, and therefore how are they going to behave in relation to my firm, and what do I need to give them comfort, for.
Thank you.
Just to add, structurally as well, if you're a pension fund, you've got a number of IC meetings with multiple different boards who need to approve an investment. So it's a lot trickier to get an investment from an institutional pension fund or an endowment fund. But once you have it, it's harder to get rid of. And so you're kind of more likely to re-up. As opposed to a family office might be quicker to make the investment decision, which can just be the main beneficiary decides, right, I want to do this, and then subscribes to the fund the next day. But he equally can be the first one to not re-up because of a structural change or a change of mood at the next fundraise.
I think this is a really important point. It's an institutional sale. So when you are setting up a fund, you need to understand that it's going to take 18 months to land an institution. And you need to think about that as how you sort of structure around that to make sure your shop is running, because again, same point, right? It takes a long time and it's really hard to get institutions on board. But once you get them, they're there unless you really, touch wood, we haven't done something so far.
Unconditionally, maybe we'll turn to the next question. Maybe Camille, for you, from the perspective of LPs, inevitably potential downturn could happen. What do you think is the most important way for GPs to manage that time period or that unexpected or sad consequence from happening? And maybe what are some of the mistakes that you've seen GPs do in trying to manage that moment?
Yeah. I would say the reality is it's not performance that is the key concern. As LPs, or institutional LPs, you understand the market comes in, there's cycles. It's to do with the way that's communicated when times are tough, right? So you've typically got, the more common mistakes which I see is three. So one of which is burying bad news, right? And it can be in the form of delayed disclosure or selective disclosure. So, for instance, in quarterly packs or in quarterly AGMs, you might have the GPs focusing on winners and everything that's doing well, and very much brushing over some of those write-downs. And we can see that straight away as an LP. Yeah. So it creates a bit of questions around trust and confidence in the manager. The next, you had a question you were going to...
No, and so you're basically expecting them to be forthcoming to show kind of the good news, but also say,
Absolutely, we want transparency. So I'll come to that. But number two, I'd say is kind of admitting realities, particularly with relation to valuations. In a down market, and if you've got public comps that have reset and kind of growth prospects that have adjusted, you'd be expected from the perspective of an LP to adjust your valuations, and we saw that in COVID. we saw some managers that were, over 2 quarters had adjusted their portfolios already by, 30%, right? And you had some others that were in the same strategy or same line of sector focus that took 2 years. And it was this gradual quarterly decline that resulted in a lack of trust and a breakdown of the relationship. And most of our clients decided not to re-up because they just didn't believe that they were being, shown the realities of the portfolio.
Yeah.
And then the last one, I would say, just over-promising in general, in terms of exits, in terms of fundraising, exaggerating during a fundraise, putting pressure on LPs to come into a close when there's plenty of capacity. I've had clients who've been really pissed off, to be frank, and decided to end a relationship when they could have just accompanied them a bit, given them a bit more flexibility around the fundraise. So yeah, in terms of what we look for, it to be transparency is the key thing.
If I may just double down on this, because the point around transparency is really crucial. Because in the same point, over-promising and so on, it all boils down to being honest and transparent about the objectives, right? Not performing. And I think that as LPs, from looking from the LP perspective, the most important update or news a GP can share with LPs is the one they are most reluctant to share. And this is what we want to know in advance and will appreciate around.
And so what are managers, in your experience, really getting wrong about what you actually do want to see?
I mean, as LPs, we look for funds that, for us, a strategic fit is one of the main objectives. So we look for funds that could strengthen our venture clienting pipeline or surface co-investment opportunities. So, of course, IRR, financial is all important, but DPI, when it comes, or if it comes, is a pleasant bonus for us, but it's not the reason we write the check in our firm. But my colleague Tura and I have seen GPs come in with a prepared, polished deck, right? That's heavily focused on financials, figures, numbers, and to be honest, they always look pretty impressive. But they rarely ask, why would us consider becoming LP in the first place? What we are trying to achieve, or what make this relationship valuable for us beyond returns? And they usually see large corporation and chase a ticket, assuming that the return should be our objective, right? And they optimize for the wrong thing.
Yeah, so they're not taking the time to really get to know what you're looking for, what informs your business, the culture of your business.
Yeah, of course, because, what they get wrong, in my humble opinion, is that it's hard for us to tell whether your projection and promise, we cannot verify it today. But what we can tell is whether we trust this person and their judgment, right? And this happens in a genuine conversation, not in a polished pitch. So for us, trust and transparency is a crucial point.
Thank you. So coming back to some of the earlier framings of the discussion, a lot has changed, in the last 5-10 years, and I think one of the biggest changes could potentially be AI. And I think foundationally, when you think about the LP-GP relationship, you think about reporting, right? So I wonder, with the advances of AI, has that made reporting easier, less of a burden? Was it such a burden in the past? And, are there other expectations that are now increasing because potentially AI can help alleviate that reporting burden? What do your guys feel about that topic?
We use AI in other parts of our firm to automate things, but not for the reporting, actually. I'm probably going to be told there's a great way I could be saving a lot of time now using AI, but there's an expectation particularly from institutional investors, of certain information in that report. A lot of it is qualitative information about the companies, which needs to be written well, and we want to highlight certain businesses, and then the data gets pulled from our portfolio management platform. So there's not a huge amount of AI. I mean, some of the portfolio management platforms have tried to implement sort of auto pulling in cap tables automatically, but guess what? It doesn't do it perfectly and it screws up. So because AI is, consistently makes mistakes. So yeah, I mean, I'd love to hear if anybody else has got a use for AI specifically in the reporting, but we use it in lots of other parts of the firm, but not for that.
I think it automates the quantitative side quite well. So, I mean, our reports, it sort of now does what used to take a while for the finance team to do gets done automatically. And then the GPs spend time writing the qualitative reports, which I think you need to make sure you still write. AI slop in that is very, very clear. The other thing I think AI has done, because I sit as an LP as well in a bunch of funds, just massively increase the amount of information that GPs are sharing with LPs, which I'm not sure is helpful. So I think you're ending up with far too much being sent, which is just noise. So we've instituted a rule that, what does this piece of information allow the LP to do? Does it allow them to do better cash planning? Does it allow them to do better portfolio understanding? And does it build trust? These are the three things. If it does any of these things, it should be included. If not, excluded.
I'm just going to say an example of sometimes where things get, there's too much information sometimes around ESG, and we've seen a lot of GP.
Too much information around the
well,
ESG.
sometimes yes. Especially if you've filed to be an Article 9 fund, and we've seen some funds backtrack on that, quite a few, because the requirements on reporting were just too great, and the reality was that it wasn't adding value. So yeah, I think you've just got to be careful and make sure you stick to material information.
Stick to the script. Camille, you had mentioned earlier some of the times or the areas where GPs get things wrong, but I'm curious to know from your vantage point, and maybe even Huseyn, we can also open it up. What are ways that GPs are kind of showing their colors with regard to operations? What GPs are doing things right with regard to operations? What do you want to see more of? What's impressing you when you are looking at a GP?
I always say that the one thing that we focus on is what differentiates you from your peers. Have you got a right to win as such? So as long as you can, as well as we like to see alignment in terms of GP commitment, putting skin in the game, not asking for ridiculous carry structures. All of those things are expectations that we have. Having a stable team, things like that. But in terms of what we need to see, the most important thing from our perspective is what separates you from the others, and that can be anything from your ability to source deals, your networks that are unique. It can be your platform, your operational capabilities that are getting access to specific, a great bench of advisors. I think you need to have something that distinguishes you from others. That's what we need to see.
Great. Other operational best practices that you would love to share and give some tips to the audience about?
Yeah, I will. Maybe one thing on top of it might be that we prefer to see consistency and transparency in the general partners, because as you rightly mentioned in the intro, that it's a decade-long relationship, right? And it should be found based on openness and transparency, honesty. Otherwise, it's not going to work. And we as LPs prefer to work with those GPs who not share good quarters well and openly, rigorously, but whether they have the reporting culture that they can share the bad news with the same rigor and openness. Because highly likely things will not go as planned. There will be ups and downs, but we would be more comfortable to work with those whom we trust. So it should not be a purely transactional interaction.
Can you actually sense when something might not be going as planned? Can you sense that in terms of the way that the GP is communicating with you or the type of information?
I think it's really hard to distinguish, but for us, maybe there are some red flags or yellow flags. In my opinion, when the report is overloaded with data, or it looks everything too polished, it seems artificial, and it's, subconsciously it signals that something might be hidden or not spelled out properly, because we as humans are wired in a way that we sense something that's artificial, fake, and we don't, trust. We trust someone who shows us something real. So maybe, and I have to give credit that both parties are guilty of that. So some GPs, whether intentionally or not, consciously or subconsciously, overload the reports just to signal the confidence or openness. And on this other side, some LPs demand standardized, extensive reporting to just simply comply with the internal processes or keep GPs at check. So, but at the end of the day, it doesn't help much. And as Shwetank mentioned, it should all boil down to one thing, that whether these interactions help move things forward or it's mere performance.
Thank you. Other thoughts here, other tips that you can share with fellow GPs that might be in the room?
Hire a CFO.
Hire a CFO.
Yeah, even first-time funds,
You'll be able to sleep at night.
get a fractional CFO. Don't do it alone. Just hire a CFO.
Yeah, if you're creating a fund, I'd go one step further actually, which is the ideal. If I started my fund again, I would get another partner who actually just owned that part of the fund, who was almost like a co-founder in the firm. Because I think depending on your size of fund, good CFOs are not cheap in the venture industry, and if you're a small fund, your fees are minimal. And it's quite hard to get somebody good who's motivated in the same way you are to be continually waking up and thinking about the reporting of your portfolio, how best to present that data. Later on in the lifetime of the companies, you've got to think about secondaries. How do we start to realize liquidity from some of our companies that aren't going to go all the way? And you can't do all of that well and also invest and also support your portfolio companies. So I think that's great advice. Second thing would be, you mentioned how have things changed right at the beginning over the last 4 or 5 years. Raising money now, I think, is LPs are surprisingly brand sensitive. If you think about across the whole of enterprise and corporate sales, the sort of prosumer and how consumer apps have sold and how software is presented has infected enterprise. I think that's now moved into the finance industry as well. So the brand of your firm and how you're out there and needing to be seen, I found, from raising the fund now in the last year versus 4 or 5 years ago, LPs have become surprisingly susceptible and sensitive to that. So, funds that have done well on brand and owned a position in the market with their brand perhaps don't have the best performance in the world, but they've still found it relatively easy to raise, because I think LPs, like us all, are now so susceptible to brands that cut through the noise, because there is so much noise and content and everything else out there. So that's something that it's funny, because I spend my life telling our founders that, and it's only in the last sort of year or 18 months I've had to eat my own dog food and start to be like, we really need to do a better job of actually pushing what we do and being more bold in the market, and it's definitely had an effect.
Yeah.
Which is podcasts, which is getting on LinkedIn, which is content, and finding a strategy and a brand that you can own and be known for.
I think you're absolutely right. I think also even the concept of branding for VCs has changed, right? So maybe branding 5, 6, 10 years ago was about what kind of post-investment support, what kind of platform support am I going to provide to my portfolio companies? But now branding is really going back to that original concept of branding, right? Like, what's our brand? How do we look, from the outside? What are we doing to share information about our culture, about our approach, rather than kind of, what other kind of activities are we doing for our portfolio companies? So interesting take.
I completely agree, and you know, it's partly because the market's so saturated. There's so many players out there, and it comes back to you need to differentiate. How do you do that? One good way of doing it is branding and you know, getting in front of people. It's a good. It's what we're seeing as well, and I think, you know, some people might call it you know, call a fund maybe aggressive in their brand building and not focusing on the fundamentals as much. But at the end of the day, what we're seeing is that those guys are converting LPs, you know, more than some of the others that are maybe a bit more humble around their capabilities and the brand. So yeah, it's definitely a dynamic that we're seeing.
Wonderful. Well, thank you all for sharing your rich insights with the audience. I can summarize. I wonder if actually there are any other questions or topics that we did not touch upon that you'd love to pose to some of our panelists. Yes. Maybe would you mind coming up here, or would someone
Got a mic
share
we given?
a microphone? Thank you.
So I had a quick question basically about when it comes to GP relationships across the globe, how different is the relationship management across different geographies and regions? Because now more and more so each fund, fundraising has become more global, and the way they operate maybe in the Middle East is different than how they operate in Asia, Europe and the US. So I just wanted to understand what are the key dynamics to keep in mind specifically in that sense.
You scared
Shwetank.
Andrew away with that question.
Andrew, thank you so much for joining us. Can we have one last photo with the group? Great, thank you.
I mean, cultural nuances exist, have always existed, so you just need to be aware of them. You know, in the Middle East, you want to start with the relationship and spend more time with the relationship, come to the, say, portfolio report right at the end, and they'll look at it after the meeting. While something in the US, it's much more transactional. They have the report right in front of you and they're just talking about it. But ultimately, you know, it's the same, as I said, different lenses, but the same truth. So you just want to make sure you're communicating transparently and consistently. So the rest of it sort of takes care of itself.
We have one more question, I think.
Sorry, is it me now? I was just given a mic, sorry. I was just going to ask a question about raising the first fund, and if you're starting from scratch, how you go about making the sort of first contact with LPs, how you begin just sort of introducing yourself broadly. Do you have any thoughts or views on how you would go about doing that from a sort of cold start? Sorry if I missed that at the start, I came in late as well.
Yeah, it's an enterprise sales cycle that you're starting. So I would say build a CRM, build a system that you're going to write at least 5 cold emails every day, and make sure you've got a 2-year plan if you're starting from a cold start for your first close.
But on top of it, you know, I have a simple analogy for that, whether you agree or not, but think of how GPs evaluate early stage deals. So usually there is no revenue, sometimes no product at all, right? But once you believe in have a conviction in the judgment and the person and the team, you back them. So that same logic applies one level up. So essentially LPs back GPs the same way GPs backed founders.
We had another question right here, and then I think we'll wrap up for the next session.
I just managed to get through the huge road, so I might have missed like a bit of context, but also on the new side of investing in venture capital, there's a huge outlier that there's like a large funds that accrue the most outliers. And the whole idea is you go for the outlier, but there's only a few outliers and you only get to them if you are the top VC. So if you are a new fund, how do you manage to sort of get into not down into the outlier fund? So if you just start out investing, like that there seems to be a very low chance you get access to the sort of the outlier multiplier startups. So you also have to convince the LPs that you are able to invest into the outlier startups, and there's sort of a positive circle, but also a negative loop you could get into. So how do you sort of approach the GTM of the high-end investment side?
Anybody want to take that?
I'm not sure I understood the question.
Same here.
Yeah, I agree. There's this dynamic because you've got the large ones, getting exposure to Anthropic and OpenAI, and it tends to be multi-stage platform established managers that have that exposure. So we're also, when we're building venture portfolios, we keep that in mind because if you come back 3 years ago, we were very much advising go as early as you can, invest in the early stage managers. We don't really want to get that later stage exposure. Today is a different picture. In terms of how do you market yourself against these guys? There's still you could still have found a breakout company, but you probably have to have found it sooner than others. So coming in earlier. I think one of the kind of the skills that you'd look for in an early stage manager these days is to try and get ahead of those big established names who might actually want to wait and see some more proof points. So that's a way of coming in, earlier, getting in front of them, giving a term sheet way quicker and that's commonly how. Because we still see emerging managers or first-time funds still getting access to some kind of breakout companies. And the story is always, we'd built that relationship so much earlier than everyone else. They happened to have fallen across the deal and then put a term sheet, but no one else was there at the time. And then at the next couple of funding rounds, all of a sudden it became apparent that this was a great company and all the big names got involved. So yeah, it's just about coming in early and looking for those deals that are less competitive.
One more question? I don't know. I think we need to wrap up. Yep. Can I borrow your microphone? That's okay. Thank you. So thank you everyone for your interest. I think we had a really rich discussion on managing the LP-GP relationship. I think we came away with kind of some guidance from our panelists that it's tougher right now, really, for GPs out there. The price of money has increased. GPs are expected to demonstrate more discipline, also more discipline in terms of the information that they're sharing to make sure that they're communicating properly, not, sending too much, not hiding kind of the realities of their performance. And also the importance these days of brand image. I think also the panelists shared some important nuance for GPs about managing their LP relationship. Not all LPs are created equal, so it's really important to establish those relationships. It's really important to also kind of be empathetic and understand that from the perspective of the LP. The LP is seeing many, many GPs, not just you. And so to be cognizant of how you're stacking up to others in the market and be prepared when you have those conversations. But all in all, I think something that, despite these changes, has stayed the same, and that is the need to establish trust, have good transparency, be honest, be forthcoming, and really just work towards the main goal that you had at the outset, which is delivering good performance. So with that, just want to thank all of the panelists again, especially those that made the distance to be here with us today. And hopefully you can catch them further on during the day for any follow-up questions. So thank you very much. Wishing you all a great day.